Well, the JSE All Share gained 2.5% in the first quarter. This was driven by industrials gaining 11.7%, financials adding 3.5%, and resources, of course, the laggards, losing 7.1%. And this category of funds, not surprisingly, the worst performers over this quarter. Welcome to all of you. Let's start off with David. David, before we get into the actual funds performances, just give us your kind of views on the key themes that we saw emerging in quarter one.
I think it was, broadly speaking, a pretty good start to the year for markets like the US, Japan. South Africa is more muted, as you mentioned. The decline in resources certainly hurts a market that is so heavily based in resources. But one of the key stories has happened since Q1 ended, and that was this historic meltdown in gold and some of the other precious metals that happened last week. We saw, I think, a single-day drop of nearly 10%, and so that's been dominating headlines and sort of what caused that, and where does that come from, and so I think that's been certainly a lot of the buzz, and won't be reflected in the numbers that we're looking at today, unfortunately.
So that's, quarter two, the story that might start playing out. What are your thoughts on the kind of the disconnect we have seen, in a sense, between equity markets and what commodities have been doing?
Well, the good news that we've going to sort of discuss to a large extent in the first quarter of this year has literally been undone in the last week of this beginning of the second quarter, where we've seen a dramatic change in risk appetite. And I think the gold bulls, in other words, the people who are worried about inflation, are not seeing that coming through anymore. So there's fear that global growth is slowing again, and therefore inflation is not going to come through, and people are dumping their gold reserves. Now, central banks might also be contributing to that. So there's this whole, and it's flooding into the equity market as well, into the sort of sentiment is being negative again, where people are worried about things just taking longer than before. The good news is that the oil price is also ticking low. It's probably down 10–12% from its peak, so that should filter through into some positiveness. We just need the rand to strengthen now, and then we've got a double whammy effect on our market.
Yeah. So David, let's delve into the top categories for quarter one, because global equity general standing out there, of course, with a 16.7% gain. What do you make of the top performers on that front?
Yeah, I think that has a lot to do with what Roland just mentioned, which is the depreciation in the rand so far this year. It's down about 8 or 9% versus the US dollar, a little less so, sort of more about 4 or 5% versus the euro, and that impacts returns to foreign funds for South African investors, and it actually provides a boost. So you saw the S&P 500 probably up about 10% so far this year. When you add in the effects of the depreciating rand, you're getting closer to a 19–20% return, I think you're seeing that reflected in the fact that these global or foreign fund categories have taken the top 3 spots here.
And of course, when you're talking about resources being hammered, it's down 7.1%. No questions asked that it was the resources category that really was the worst performer.
Yeah, have a look at your screen quickly, and you'll see the worst performing categories, and that's just basically at the top level. When you look at, and there you can see it, South African resources down -2.4% year to date, or 3 months. South African interest-bearing variable term up 1.1%, and then South African interest-bearing, and that's really just money market, up by 1.2%. Let's just hone in a little bit in the resources sector here. Let's just quickly have a look at some of those returns. And you can see there, Old Mutual Gold down -8.5%, and any of those are kind of resource-based funds. I think for me, kind of the sad thing is that finally people have made up their minds that maybe we shouldn't be owning resources, or should I say rather gold long term. But this has kind of gone hand in glove with the fact that we've had some economic news that have come out specifically from China that have going to be negative.
Yeah.
And we've just kind of seen this broad sell-off. Gold has obviously led that sell-off, and I'd probably say that that'll probably continue, because what is the fair value for gold? We don't actually know what the fair value for gold is.
Yeah.
Whereas some of the other ones, we can actually understand what some of the fair value for the, as far as those are concerned.
But it's almost like, that's happened to towards the end of quarter three, but resources were almost out of favor for the majority so quarter one, what I'm talking about here, but resources were out of favor for the majority of quarter one. So when everyone was pricing in potential recovery, given the fact that they were trading at such low valuations, it hasn't come through yet.
But you know, the interesting thing for me here is that if you cyclically adjust the earnings cycle for resources, they're actually now at a basis where you can actually start looking at them and start valuing them and actually start buying some of these. Now, your period in order to try and gain return out of these is probably quite long. So therefore, you're kind of buying them into your fund, or you're buying them as ideas into your portfolios, and you're kind of holding them because for the next 5 years, you're potentially going to be making lots of money out of them. The interesting thing is, despite valuation, you've got financials and industrials that continue to run. Financials, obviously, during the sell down has come down quite a bit, but industrials have just continued to kind of just be steady, you know, and those are the stuff really on the high valuations.
Yeah. David, I mean, what is interesting also, if you look at the domestic equity resources, the worst performers there, I mean, star ratings, for example, the Old Mutual sitting with a 5-star rating. So these are top rated by Morningstar, yet, of course, when you look at them on the short-term basis, certainly underperforming in light of all the sentiment right now.
Yeah, I think you hit on the key aspect, which is the Morningstar rating does look at longer periods of time. It looks at 3, 5, and 10 years. If funds do have a 10-year period. So, you know, it certainly is possible for 5-star rated funds to do poorly in the short term, and it's certainly possible for them to no longer produce 5-star returns going forward. But you know, a 1 month, or sorry, a 1 quarter period of time just isn't enough to sort of draw any reasonable conclusions. I think it just reflects the volatility when you have a fund that has such a concentrated mandate to only invest in, you know, certain particular types of stock like resource stocks.
I mean, let's move a little bit to best domestic equity. I mean, these are mandates in essence that literally give you equity exposures. A little bit of cash exposure maybe from time to time, but the emphasis here is on equities and owning equities. So let's have a look at who the top performing managers were as far as domestic equities are concerned. You can see there, Chris Mayer's Quant Fund, the India Equity Technical Fund, that's up 8.6%. That's obviously a quantitative-based fund, and Roland, that's certainly up Roland's alley. Walter Aylett's Aylett Equity Fund up 8.6%, and then PSG Equity up 8.1%. So I mean, certainly some decent returns that we've seen out of equities for certain managers. On the worst domestic equity side, look at the quarter returns there. Stand-Up Nation Builder down minus 2.3%. Prescient Living Planet Fund, that's down minus 1.8%, and Investec Value, that's obviously John Bickhart's fund, which is down minus 1.4%. I mean, that's been a fund that's been kind of battling for quite a while, you know, as far as returns are concerned. Anything that kind of stands out for you here, David, as far as domestic equities are concerned?
Yeah, I think one thing that seems pretty clear is there's you notice a couple value funds on that list of worst performing domestic equity. In the case of Investec Value, I know that John Bickart has a huge position in materials. I think it's about 40% of the fund, and it's just a very concentrated fund in general. I think consumer discretionary is another quarter of the fund, and so, you know, the overwhelming majority of assets are in 2 or 3 sectors. So those are really big bets to place. And they can work out either well or poorly. But you were sort of mentioning earlier that resources are maybe getting to the point where there's it's worth looking at in terms of finding some value. And it appears, you know, from the portfolio that John Bickart is looking in that space as well. But, you know, it hasn't played out well. The other thing is, you know, I mentioned that we had a huge drop in sort of on the materials space. A lot of his positions, unfortunately, are in gold, and so that fund I think is down about another 7 or 8% just in April alone. So I think you're noticing value funds it's a tough market for them right now.
In terms of the returns we saw for the best poor performers, would you compare that to the All Share gaining 2.5% in the quarter, and some of these performances coming through, or returns coming through with an over 8% return?
Well, again, the first quarter has unwound itself in the first 2 weeks of this quarter. So the All Share index is actually down 3% year to date now, but it was up 3% 2-3 weeks ago. So market has definitely taken a turn turn for the worse. But on these value shares, I mean, the kind of value that hasn't really been working over the last year are sort of low PE kind of shares. And we're now starting to see things like we're seeing here the dividend plus index, which is a high yield index. So yield is also not working anymore. So we're probably entering a period where the stocks that are generating earnings growth, in other words, it's more of a growth market, have done really well. The retailers and these kind of shares that and to some extent financials as well, showing robust earnings rather than cheapness in terms of price. So the value trap is constantly catching the value investors out, and that's why they're at the bottom of the list. But you know, in the long run, value works, but in the short run, for 2-3 years, it can be quite bad.
It's a scary situation for investors to watch.
I want to take up there what Roland just said, and that is that, I mean, this makes portfolio construction difficult, because if you're going to be buying cheap stock, you're not necessarily getting rewarded for that in the midterm. Maybe long term you'll be rewarded for this, and certainly then we'll start seeing those Divi Plus kind of indices, you know, kind of going back to the forefront as far as returns are concerned. But right now, in order to do portfolio construction is really, really difficult. So you're kind of sitting between cash and trying to kind of put money into equities, but you're trying to kind of be true to a growth story, but you're trying to get your valuations right, and those sometimes very difficult to do.
You know, solid investment principles that, you know, it does take time, and there is so much noise at the moment, and the world is on this slow recovery path.
Yeah,
for how much longer we don't know.
Well, exactly, and I mean that is what makes this what makes this thing just, you know, so difficult at the moment. Let's move to domestic, or shall I rather say best global equity. Have a look at the table that kind of reflects what's been happening as far as global equity is concerned. You can see the Old Mutual's Global Equity Fund. That's top there of the pops over the quarter, 22.9%. That's a fund run by Ian Heslop. The benchmark there is the MSCI. And then obviously a firm favorite with investors, and something most investors would know, is the Alan Gray Orbis Global Equity Fund. 5-star ranking there, 22.8%. Let's move to what we call worst global equity. So that's the bottom of the category. And there you can see Old Mutual Emerging Markets Fund. That's a fund run there by a gentleman by the name of Anwar Wagner. MSCI Emerging Markets is the benchmark over there. And then Some Global Best Ideas is the second one there, run by Koki Koeman and Do Steenekamp, who should be no stranger to kind of the fund management industry.
And certainly those worst performances are nothing to snark at, because they certainly are a lot better than what you would have got if you were in the domestic equity front on the worst performance returns. David, global equity, I mean, certainly powering ahead, and as you say, pretty much in line with what global markets have been doing.
Yeah, I mean, the funny that Old Mutual Global Equity Fund is a very well diversified fund. I think, you know, the top position in the fund is Apple at 1.5%. IBM sort of 1.3. So it owns a lot of different names. It's spread out geographically, obviously heavy in the US. I think it sort of reflects the overall market, very sort of similar to the MSCI World. So it's not that the manager really took aggressive bets and swung for the fences and just happened to get lucky and produce that type of return. As you mentioned, I think that return is reflecting, number one, the strength in the US and Asian markets, particularly Japan, and then the depreciation of the rand, which has benefited investors in those funds, South African investors in those funds.
David, can you just give us maybe a bit more understanding of what global equity means? Is it any kind of fund globally, or is it, I mean, it can be emerging markets, it can be developed markets, it can be a bit of both, or is there some kind of cutoff or definition of this category?
Yeah, I think it's looking primarily at anything outside of South Africa. It is including, as you see, some of the emerging market funds. So it's really, you know, these are funds that aren't Reg 28 compliant, that don't try to keep you know, a significant percentage of their assets in South Africa, and so that's you don't get some, at times they're not perfect comparisons. For example, you know, an emerging markets fund versus a global equity fund.